Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey Patrick, back again. How are you doing?
Doing great. How are you?
Can complain, sir. Can complain.
Uh,
We thought we'll, just get the ball or could keep the ball rolling on Practical Nerds with a new one, but a relatively shorter episode, perhaps.
yeah, let's do a shorter one. We want to nerd out about the topic of burn and what makes a great burn. So I guess that is a topic that is constantly on founders' minds. I know it is on some investors' minds and
hmm
perhaps not everyone's, but certainly on founders. Um, do you run into that topic a lot with either portfolio firms or prospective partnerships?
I do, surprisingly a lot. And what I've realized is I have found it to be a very contentious topic in the sense it becomes very core to my assessment of how founders are thinking about it, how much they understand what they're doing.
Hmm.
And this includes both burn, as in the uh, recent performance of how burn has been, but also what burn founders think they will need to have or achieve in order to deliver on certain targets. And interestingly enough, I also find cases where my understanding or my belief on what the burn should be or could be, because it's very different from what, say, the founder or another set of investors have, it leads to a dramatically different assessment of the firm. And I find it interesting because in a lot of circles, burn is treated as, hey, it's just a sliding scale of what determines runway. But actually, it's so much more
Hmm.
material than that, because burn directly then feeds into how much you raise or you think you need to raise. That then feeds into either valuation or dilution, or probably a bit of both. And that therefore changes so many other things around the business.
And let's. I'm actually interested, Shu. Before we exchange more thoughts on this, perhaps a quick definition because it can already be confused in discussions. When we talk about burn, or you specifically, Shu, do you consider P&L burn or cash burn?
Oh, good question. So, in general, P&L burn. By the way, I presume when you say cash burn, you mean the net cash that you have less from a cash flow statement perspective every month or
Correct.
every quarter.
Exactly,
So,
because it might actually not be burned. Some of that cash might come back in a few months if it's working capital.
exactly, correct. So, in general, I'm speaking about P&L burn. As for the cash flow reduction or being less, uh, it could be a good thing or it could be a bad thing. I would say it
Hmm.
depends. It very much depends on how it's put to use.
Okay. Yeah, I
Yeah.
would I would agree to that. It's uh, assume an example of, for example, a P&L break-even marketplace in construction,
hmm
but that is burning, so to speak, in the eyes of some investors cash because it uses working capital. Let's say
Yeah.
70 working capital days. In that instance, if I see such a business, or actually we have businesses like that in our portfolio who are net profitable on a P&L basis, but who are
Yeah.
using working capital to get there, the thing I'm not interested in cash burn in that instance. I'm interested in the ROCE or the ROIC on the
Correct.
working capital. So if that is above, we usually say 20% on
hmm
an annualized return basis, you have a business that in the end is using the cash that you're burning. You're not truly burning it, but you're burning
Yeah.
um, to generate P&L profit out of it. So that's already like the first thing. If you make sure that whoever you talk to about your burn, be it your co-founders or investors, make sure you actually talk about the same definition, right?
Yeah. I mean, recently, just to further dig down on this point before we move on to other topics, an extremely successful founder I met recently, who's also raised from several of the best investors in the world or the most revered investors in the world, even went to the extent of telling me, no investor actually even sees the balance sheet; they just see the P&L. And I think he made a comment
That's
that
right.
even the process of reading the balance sheet as part of a diligence has only emerged in the last year or two,
Yeah.
which I thought was fascinating. And,
Yeah,
and
it
the
checks
reason I'm
out though.
saying this, the reason I'm saying this is what you just spoke about, working capital, that will not show up in the P&L, that will show up in the balance sheet.
And it will show up in the cash flow statement. It's
Yeah.
actually, I mean, most, for example, most people that have done a ton of M&A, I hail from a M&A background way back when. I haven't done it in a long time, but what I've learned back then is most people that, for example, hail from a corporate finance and M&A background, they will treat the cash flow statement as the
Hmm.
most important of the three
Hmm.
financial statements, and that will reveal most about the company. And that's why you would also see the working capital, for example.
Correct.
Um,
Correct.
Okay, so definitions, right? So that's important. So I think for the purpose of this episode, we'll spoke mostly about P&L burn.
Hmm.
But my first take about this is that there is no one singular metric, not an absolute number of the burn, nor an absolute metric, say the burn multiple, or there are other metrics that, for example, you mentioned Bessemer had
Hmm.
to be in the pre-discussion. You mentioned Bessemer. That there is no singular metric or a singular absolute number that I would consider as this should be your burn.
Yeah.
It's always context specific. It's and there's different aspects of context that I just want to shout out to our audience to consider as their context when they come to the conclusion about what's a good or a bad burn. Number one, what is your business model?
Hmm.
If your business model is a marketplace, or if your business model is a SaaS, or if your business model is an outcome as a service, the burn that you should expect from yourself can differ vastly. So
Yeah.
make sure you're comparing apples with apples on the business model side. Two, the stage. It will be, if you're a 10-year-old company that burned through 100 million, can you truly justify that you need another 100 million to burn? It could be if you consider the other aspects of the context, but the stage of your business, that is really important. Three, what is the assets that you're building? So assets
Hmm.
could be distribution channels, assets could be IP, technology, hardware technology, robotics.
Yeah.
Assets could be your brand, sort of part of distribution. So make sure that you understand really what you're burning for in the asset sense. What is the asset that you're building? And I think one of the lost arts that founders as well as investors should consider more often is that in the end, I'm building an asset to leverage it. That's the beauty of book printing or
Hmm.
of SaaS when people consider it is I build something once and then I can leverage it almost infinitely. So whatever you burn cash for to build an asset should be an asset that I can leverage. And so
Yeah.
that's another context aspect is if I'm building a hyper leverageable asset that is hyper difficult to build, my reasons for burning are vastly different than if I'm building a non-defensible and low leverage type asset. So that's a few of the aspects that I would consider in the context of determining what's a good or bad burn.
Yeah, I think there's multiple things to break down further on what you said. I think at a very high level, in my mind, there's two major threads to pull from what you said. One is about pacing your burn relative to where you are in your journey and ramping it up. And maybe we'll come back on to this on what I mean and what this means for founders building. The other is what you're actually burning on, what it means for your business. Is it creating value? And perhaps we could
Yes.
start. Perhaps you could start there. Um, I think again, this is like the traditional wisdom that all companies kind of look like different versions of tech companies, the standard template, and therefore, I think all of us we've come across situations where a company, regardless of what it is doing, it'll have this generic template of, hey, this many tech resources, this many marketing resources, and stuff like that, and artificially inflate the burn. Even though, for example, perhaps you're a marketplace or a supply chain company where some of these spends are not that critical at an early stage, especially in a B2B context, but you're nevertheless just burning it. And in response to what you said, you're not really building up assets in the early days if that's where
Yes.
you're spending your money.
I fully agree. I actually want to look up one number
Hmm.
because it's sort of the counter example to when you're not burning enough because you're not perhaps building up enough assets and you're almost resting on your laurels. So let me give
Okay.
you, Shub, sorry, I'm putting you on the spot now. We didn't prepare this.
Hmm.
And I now have the benefit of just Googling it. Take a guess.
Okay.
What is the net income of Alphabet, the parent company of Google?
If I had to take a guess, I would say around 20 to 23%.
And in absolute terms, what would you say?
Oh, okay, hang on. So, I think the revenue, oh, sorry, the profit should, if I'm not mistaken, should be around 70, 80 billion. Yeah, I think the net income should be around 70, 80 billion.
That's perfect. It's 82. It's
Oh,
82
wow. Okay.
billion. Yeah.
I
I mean, and
surprised
we
and
did not
impressed
prepare
myself.
this. We did not
Okay.
prepare this. This was Shub on the spot. So 82 billion. Why do I pick this? Because a bad burn can also be that you're resting on your laurels and you're not building enough new assets. And in my mind, this is a personal opinion, no financial advice.
Hmm.
I'm not against Google. In fact, I'm an avid Google user, but I am telling you, in my mind, this company is 30 years old and it actually doesn't innovate anything. In
Hmm.
fact, the software that I use, Google Sheets, for example, I just use it because it's still better than the incumbent spreadsheet solution, which I consider absolute dog shit.
Hmm.
But I wish someone actually gave me way better tools, and I wish it to be Google. They have such a distribution advantage with their
Hmm.
client base. And yet, I never get new products out of them. I never even get improvements of the existing products. And
Yeah.
I'm their asset. You're their asset. All of us are their asset, but they are just not compounding on it. And where do I see that? I see that because they're actually just printing money
Hmm.
without innovating. And to me, again, this is going back to context. If I look at 82 billion as a singular data point, I would be thrilled as a stockholder, which I'm not, of Google, because I'm like, hey, this is just I mean, it's one of the most cash generative tech companies that I
Yeah.
could ever be invested in. Fantastic. But when I consider it in the context of, is this company actually reinventing this itself? Is it building new assets that, 30 years from now, I would also be in that same position? If I consider it in that context, I would say they're not burning enough, or at
Yeah.
least reducing their profit in a way. Amazon is the counterexample. I mean, has Amazon
Yeah.
ever printed a net profit actually?
It has, but it goes through ups and downs. Um, I think right now they're back to being profitable, but there definitely was a 2, 3 year phase where they were deeply in the negative.
And I mean,
Yeah.
Jeff Bezos' philosophy was always to be in the negative, and basically his logic was, hey, I can save the whatever it is, 30% taxes that my business would
Hmm.
be taxed on, and treat that as investment on my business, and that's why he goes to zero, break even, or below, right? Although Amazon is probably a company that if they truly wanted, they could print a massive profit every
Hmm.
year, and that comes from the perspective, to your point, of, hey, am I actually earning an ROI on
Hmm.
the cash that I'm burning? And the ROI could be in the form of building assets that are leverageable for the future, or it could be in the form of reinforced distribution channels, unfair
Yeah.
access, etc. So whatever you do, to your point, burn it because you earn an ROI on it.
Hmm. Hmm. I mean, so I think, if you break it down by model, there's many other things to talk about. So for example, if you're a SaaS company, do you really need as much R&D and sales staff in the early days as you're perhaps putting? Perhaps there's an argument to be made that the sales team needs to be more gradually ramped up as you achieve product market fit. I mean, but by the way, that I think the alignment of burn with product market fit, which was, I think, a part of what I highlighted as the first takeaway from your statement. But I think that isn't spoken of enough, where you maximize burn when you have found product market fit, which for some reason
I love it.
it's completely backwards with most conversations I have, where the belief is you immediately off the get go need to keep burning a ton of money, and then magically the expectation is with product market fit the burn will go down. But that is so if you are a company that needs burn, that is probably not how it will go down.
I love it. Let me run with this example. So let's consider an enterprise SaaS company that serves general contractors, large
Hmm.
general contractors. And if I'm pre-product market fit, the following methodology will not work. But once the firm thinks it has product market fit, you would typically see a large sales staff, maybe some large marketing spend.
Mhm.
And at that point, I can evaluate the burn of the company in context with the ARR per FTE. Why
Yeah.
ARR per FTE? Because it is a measure of my effectiveness to distribute my product that is supposedly post product market fit to my enterprise customers, and it contains so much of the distribution problems or advantages, like how long is my sales cycle, how efficient is my sales force in relation to their salary. And so
Mhm.
if I take the ARR per FTE in this example, and I had a Construtech enterprise SaaS company that has 400,000 or more ARR per FTE, but it would perhaps burn, just to put out a number, 10 million. What that would tell me is that the 10 million might be entirely justified because they have a hyper efficient distribution in hopefully a large enough market, and they are
Mhm.
investing a metric shit ton on product, but not
Mhm.
on distribution. If the
Yeah.
same company had 70,000 ARR per FTE and a 10 million burn, I would be inclined to say they're probably burning too much on distribution, but not on our
Yeah.
engineering, or on both. And it's probably not going to be a scalable company. So the perspective of burn, it's the same 10 million can entirely vary in exactly the same model, exactly the same market, just by looking at another metric like that in context.
Yeah. I mean, so I feel like all the different threads are bleeding into each other. So maybe let me also lean in by what I mean with, are you building assets? What time of your journey align with product market fit? And to come back to the original question, why it could even be an existential aspect to your company's future. And it's not just a question of runway. So to give you an example, and by the way, this happens way more often than you may realize, but I'll give you an example of what I mean. So say that we are talking to an early stage company trying to build a marketplace or say supply chain solution. We, based on many examples you're familiar with within our portfolio and successful examples outside, know that a pre-launch company doing something like that would probably not need more than give or take 1 million, say for example, for the first year or two of such a operation. But the company wants to raise 4 million, 5 million,
Hmm.
6 million because it has made certain assumptions. Now, what happens is, and let's say some investors even buy that story. So what happens is you have now designed your business to with the assumptions that you need to or have to burn that money over the next, say, 1.5, 2 years. And they think, okay, that's perhaps an indicator of momentum. But what happens is, as a prospective investor of the pre-seed round, my diligence or my process isn't limited to just what you look like today. I also need to know what this represents for the company's prospects a year or two down the line. So what it tells me is, hey, if this is what your plan is, if you think you can only get there by burning 4, 5, 6 million today as a pre-seed company, when you have not even started, when there's obviously enormous room for failure, the bar for what you need to deliver a year or two down the line is much higher, right?
Yeah.
Because you've already burned through a ton of money at this point, so you better deliver, in response to what you said, have built up assets, built up momentum, but also in order to deliver any sort of markup to the early stage investors, you won't get there unless you've delivered progress. Or the requisite progress to deliver a markup to the earlier stage investors. So at that point, what I'm doing, the math in my head is, hey, is the risk reward worth it? So the probabilities are not with the founder at that point. Where what you're saying is, hey, I'm putting pressure on myself to burn all this money, and I need not should but need to hit a much higher number a year or two down the line, just in order to make the next round.
So, question for you in that regard. In the example you're giving,
Mm-hmm.
and you were just to call it out again for the listeners, you were saying this in the context of a marketplace or logistics supply chains.
Something, yeah, let's say that. Yeah.
A company like that. So we know that one or two would be well invested for a business like that.
Mm-hmm.
But they might get 5 or 6. the difference of 4 million
Mhm.
in that regard, is that then invested on exploratory stuff that I shouldn't be investing on right now? Is that something you're seeing too often?
So, look, the truth is usually somewhere in the middle. In the sense, the founders and the investors who come along for the ride in those kinds of rounds, for the most part, will not tell themselves it's exploratory stuff. But what happens is, and this is more human psychology than entrepreneurship, perhaps, because you feel you have more resources, you also give yourself more reasons and excuses to fail or kind of spread the resources around, right? It's, for example, if you're a billionaire, a few million here and there spread out will not really hurt you. So
Yeah.
therefore, you also give yourself, if you have 6 million instead of a million, you tell yourself, okay, you know what? If I spend 100K more every month, so what, right? I can make do. I'll
Yeah.
catch up with it. But the thing is, if you don't catch up with it, everything will you'll be answerable within a year or so,
Yeah.
right? And that point, the only way you'll catch up is either a down round, or if people don't come up, the company will go belly up very quickly.
So I want to
So yeah.
I want to put this in an economics way of thinking about it, what you just said. I'm not going to say anything different. I just want to double underline it and perhaps
Mhm.
give it more of a different view on the same thing. So what we're saying is, let's say you have 6 million in the bank account and you're burning an additional million. Your perspective might be, in absolute terms, my fate of my company right now is not changing. My
Mhm.
bank account might be in the end of the year 2 million instead of 3 million, 4 instead of 5 million. But and you might do that being aware that the marginal utility of the next euro that you spend by spending this additional 100,000 or 1 million is going down. You might even be aware
Yeah.
of that. But you might be applying the wrong utility metric to your
Mhm.
marginal utility calculation. You might think, hey, the marginal utility is measured in return that I'm getting right now on my investment. That's a perspective. But the
Yeah.
true perspective that you're pointing out is actually you should be measuring your marginal utility in the value of your equity in a year or two from now. That is the
Mhm.
true factor in the marginal utility calculation. And actually, it might look to you like, yeah, you know what, the marginal utility decreased, but I got a little bit of an additional asset, or I got a little bit of an additional insight.
Mhm.
It was not as well spent as the first dollar I spent, but that's actually not the perspective. The perspective
Yeah.
is that the marginal utility might actually be going down or even be going negative, because you will be judged on the value of your equity that you generated in a year or two from now, for example, in the context of a down round. And then your marginal utility was not just smaller, it was actually negative.
Yeah.
And so that's then problematic. And so you might be applying the wrong measure of what do I measure my return on, when it
Mhm.
should be the price of your equity.
Yeah. And I think when the scenario you just described, when it comes together in an unfavorable way, and what I mean by unfavorable way is, the more excess money you get earlier in your journey, if that sort of combines, the probability that you as founders or as early investors or leadership employees slip into a comfort zone sort of mentality, the probability of that exponentially goes up,
Very
because you
true.
always believe you have lots and lots of room for failure, right? And if you think about it, that is kind of why corporates don't succeed as much in innovation, because corporates generally believe there's lots of room for failure. They'll not go out of business if they fail. A startup, by definition, is not supposed to have that sort of comfort zone. So if you as a startup give yourself that comfort zone, you're dramatically decreasing your probability of success.
I love that. You mentioned the topic of runway. I also wanted to take us away with that, and I think I can tie it in with what you just said. I have made the same observation that burn and the cash in my bank, in the context of a construction tech startup or any other startup, is oftentimes treated as, okay, this is how much runway I have. And the problem with that is, if I mentally approach it that way, I'm not approaching my business from a resource allocation and investment perspective, what resources am I investing to build up what kinds of assets, I'm approaching it in a survival kind of way where I'm saying, hey, this is how much time I have to prove something, or this is how much time I have to explore something. And so it's a very different type of mindset just by how I phrase the perspective of cash versus burn. And the way you should be doing it is, this is my cash, this is my burn. Let me treat it as a resource allocation to invest in building something. Once
Yeah.
I treat it that way and I take out the time component of cash versus burn, it's much easier to be in that in a mindset where I actually use my burn for capital efficiency. And that's the point I'm making is, don't even think of burn as burn. Think of your business as capital efficient or not. That is just the point, because once you treat it that way, you will be thinking as an investor in your business rather than a cost center that is supposed to burn money. Here's a very scary anecdote, actually, to that point. It's comical almost, but I thought it was scary. So there was a unicorn business in prop tech with a little bit of renovation tech that I know fairly well. Not a portfolio company of ours, though. Top-notch founders. Really like them. They have since gone on. Two of the three have since gone on building another successful business. And it was either 2020 or early 2021, so peak season of zero interest rate policy environment, lots of VC around. These guys were scaling relatively quickly within 4 or 5 years to several hundred million of GTV/GMV.
Okay.
So here comes and the founder is I would call him a friend. So he shared this story with me a year or so ago after the fact. So here comes an investor, and that investor meets that founder at an event. That investor had never had the chance to speak with them before, but had heard great things and blah, blah, blah. So this investor chats them up and asks him, hey, how much are you burning? And so the founder goes, well, this is how much. I thought that was a scary number, like
Okay.
7 digits.
Okay.
The reaction of
Every month?
Yeah.
Oh, okay.
Yes. The reaction of this investor was, Shub, I'm not kidding you, that is awesome. You should come and teach my portfolio founders how to burn that much. I'm not kidding you. That's what he said. And I was like, hey, why did he say it that way? And so the founder, right? And so I asked the founder, and the founder said, well, I think it was at the time when everybody thought they could buy growth. And most founders, I mean, some of them do stupid things, but not because they're stupid, just because perhaps the context makes them do stupid things. And that was the time when that happened. And he said, probably his founders in the portfolio didn't know where to put all the money that they were raising in a capital efficient way, where to invest it. But the investor was like, hey, they're not burning enough. Because they're not burning enough, they're not growing enough. Can you come and teach my companies to burn? Shub, this says so much about founders should be their first investors. They should be the ones that treat capital as an investment item to allocate these resources into things that actually compound. And when from the outside someone wants to tell you you should burn more, ask why and have that conversation, because time will come again when money is even more accessible than it already is right now, and we will be back in exactly that hamster wheel where people will want to make you burn again. And a great founder, they will consider the context of everything.
Yeah, I mean, actually, that also reminds me, something that comes up obviously in the conversations that we have sometimes with the outside world. Interesting nugget of fact. We actually have 8 portfolio companies in Fundamental which are or recently have been net profitable, which for context is about 1/8 or 1/9 of the number of companies we have invested in already. And obviously, our ambition is many more companies become more profitable faster. So a lot of times when people hear this, given that we are a relatively young fund, they're surprised at how many net profitable companies we already have. And sometimes they wonder if that means that these are slower companies, etc. But without sharing names, many of these are amongst our best portfolio companies. In fact, there's actually a high correlation that our
Indeed.
best companies and fastest growing companies are or have been net profitable. Um, so what I think that is perhaps one takeaway I wish more founders and also frankly more investors, perhaps this goes more to investors than founders, would realize that being profitable does not mean or does not need to mean that you compromise on ambition or rate of growth, etc. There's smart and hacky ways of achieving your growth without having to burn. I mean, in this episode, we haven't even talked about the use of debt, etc. That's a completely different
Yes.
topic, perhaps a topic to take up in a different Practical Nerds episode. But hey, I mean, perhaps you don't burn, but you rotate debt and preserve equity and use that to scale. And you create value that way. And being profitable or being a low burn company gives you that option. It's an option which high burn companies don't have.
I love it. I want to come to, by the way, I'm really glad that you're calling this out. And one of the fascinating things that I have learned, one of the things that I have learned are fascinating to new investors that really want to spend time in our sector, architecture, engineering, construction, and supply chains. So they commit to learning it. These people find fascinating that when they learn that this sector actually favors becoming net profitable relatively early. And it has to do with the fact that you can build outcome as a service type businesses in buy ready markets, buy ready processes with relatively high margins, which they're not used to be seeing. But ours, and they come into the sector oftentimes with a prejudice, oh, it's so old school and it's so inefficient, etc. Well, your inefficiency is my margin. And that's what you
Yeah.
actually see in this sector. So just a quick comment on what you said. And I love that you shouted that out because founders will find this opportunity, especially because of that in
Mm-hmm.
AECS. One more point I want to make. The best advice I can also give with burn is don't treat it only as a bottom line item in your
Mm-hmm.
P&L and don't treat your P&L monolithic. As you actually expand your business, you will find that you will have some kind of core business, and then you will add some kind of new products or new services or new geographies, new cities. You will constantly be doing something new over time. And
Mm-hmm.
you should look at the burn of your P&L not only in that monolithic way, but actually in a division or product or service or geography kind of way. And what you will
Mm-hmm.
find is that ideally your core business should be profitable,
Yeah.
and I'm speaking net profitable. And at some
Mm-hmm.
point, you need to stop burning on it. You need to
Yeah.
stop. Basically, you need to finance the product development, the improvement of the product through the cash that you generate from that and the operations from the cash that you generate. And your burn should go into the other parts of your P&L where you build up a new product that you add on
Mm-hmm.
top or you build up a new market. That's where your cash burn should go. And if you look at your P&L only monolithically and you only look at that bottom line of cash burn, you will never have that kind of insight and it will lead to inefficient resource allocation. So
Mm-hmm.
that's a, I think, very
Yeah.
underappreciated art, both between founders and investors, is to carve up the P&L into products or geographies or divisions and treat burn and capital efficiency, one by one.
Absolutely. I fully agree. I really wish more companies and investors would actually treat company building and capital allocation in that form.
Yeah. We are seeing it in our marketplaces where oftentimes they would treat it more like category by category. Isn't that right?
Mm-hmm. Absolutely. Yeah.
Cool. Shub, any parting words with regard to capital efficiency and burn?
I think this is a topic which is, as I realized doing this, there's actually threads which each of them can be separate episodes. Perhaps we could pick this back up in a few weeks. And I think I really wish there's more aspects of this which more founders and more investors would give respect to.
You would have been a good showman. Always leave them wanting is the motto.
Or always leave it half completed, you mean?
Cliffhangers. Okay. Cool. Do you want to do our little ritual or do we save it for next time?
I mean, we can do it.
Go ahead.
Yeah. There is like a service as a service company I'm quite excited about.
And you're
Um,
meeting them?
I am, yes.
Okay.
Yeah.
Um, I'm looking forward to spending some time in Berlin after a while. I mean, people who know me
Nice.
know that I stay away um, from the tech hype centers
Mm-hmm.
as much as possible. And I've actually found, I don't think I've ever said this online, but I've said it to you privately. I've actually found it to be almost a competitive advantage staying away for two reasons. One, it allows me to evaluate companies and founders and markets more for what they are than
Mm-hmm.
for what other people say about them. Whereas
Mm-hmm.
if you immerse yourself into the tech centers like 100% of your time, it's so much harder to
Mm-hmm.
ignore what is being said. So that's one. And two, I've even found like people say to me, "Hey, I love that you're not here. I'd love to
Mm-hmm.
speak to you." And so, um, with all that said, I am also looking forward when every now and then I get to spend time there. And so, Berlin, here I come
Nice.
next week.
Nice. I mean, I can identify with what you said. I get asked that often as well, like, do I think I'm away from the action trying to cover Asia Pacific from Berlin? Um, the short answer is I don't, and I think there's some structural advantages to that
Exactly.
arrangement. Yeah.
Exactly. All right, sir. Well, look forward to it and see you next time.
See you soon, sir.